Common deductions and their limitations. We're not going to go into every business deduction today. I don't want to put you to sleep. But I do want to point out some of the biggest qualified business deductions that may have limitations on what you can and can't write off. So let's begin. First off, startup costs. All too often, I see new entrepreneurs invest large amounts of money into their startup as a business owner, thinking they can write it all off on their taxes in the current year. Unfortunately, the IRS has a cap on these startup costs, which is currently $5,000. Also, many startup costs are capital assets that depreciate and have to be written off over time. So if you're just starting out, you may want to consider this fact before investing too much upfront into the business because it might not give you the immediate tax break you're expecting. Next, we have inventory. If you are a manufacturer or selling a product, you want to listen up. Inventory isn't expensed until it's sold. The biggest challenge I see with people who have inventory is that they're cash poor. They don't understand that your inventory costs aren't all written off in the same year that you purchase it. Before an item is sold, it is considered a capital asset and goes on your balance sheet. Items that go into inventory include manufacturing costs like raw material, freight, direct labor, and the benefits for that direct labor, factory overhead, retail costs like wholesale purchases are some examples. As a practice, you should be doing a manual inventory count at the end of each year in preparation for taxes. So how do we book inventory? Well, inventory, as I mentioned earlier, is a capital asset, goes on your balance sheet, but it eventually gets posted as cost of goods sold on your profit and loss statement. Cost of goods sold is the total amount your business paid as a cost directly related to the sale of such product. If the logistics of recording inventory and cost of goods sold feels overwhelming, don't get discouraged. You can still run a thriving retail business. Many people do, and you can too. If you set up your point of sale application and bookkeeping software in the correct way from the beginning, it can help you with this and even make your life a lot easier. Next, we're going into automotive. If you use a vehicle for your business purposes, you can deduct that business use and any related upkeep to that vehicle, including insurance. We call this, in the tax world, actual expense method. To make deductions, you need to determine your eligible business percentage. If your vehicle is only used for business purposes, then all expenses are 100% deductible. If you have a mixed-use vehicle, meaning you use it for personal and business, you'll need to calculate the percentage of your vehicle that is used for business versus personal. The IRS requires you to keep a mileage log, so don't get left with unprepared tax planning. You can do this in an app like QuickBooks or other apps that are out there. Or you can do it the old-fashioned way and keep a written mileage log. You need to prove that the mileage was used for business purposes, so note what business purpose it was used for when you're writing the distances. You'll also want to record your mileage at the start of the year to the end of the year in your mileage log or app. This is important for tracking purposes. There are two ways you can take a deduction for a vehicle. So let's dive into the actual expense method. At tax time, you'll take the total miles driven in the given tax year and divide that by your business use mileage to determine your business rate of deduction. This is the actual expense. Another option is to take the IRS standard mileage rate, which as of filming is 62.5 cents per mile. Multiply this by your total mileage to get your business expense. This may be easier, but there are cases where the actual expense method could save you more in taxes. Please note that the mileage from your primary workplace is not eligible in the consideration of your business mileage. Many people get tripped up on this, so I want to remind you that that cannot be included in your total calculation. Next, we have business meals. Do you have food or drinks with an existing client, potential client, colleague, or at a networking event? This expense is most likely deductible at 50%. Under the current tax rule, as of this video, this expense is most likely deductible at 50% of your total cost. Alternatively, staff events like an appreciation dinner or celebratory lunch in the office is deductible at 100%. So keep records and distinguish the difference between business purposes and the event in case of an audit. So please keep record to distinguish the difference and business purpose in the event of an audit. Next, we have business entertainment. Due to the Tax Cuts and Jobs Act enacted in 2018, entertainment for clients or prospective clients are no longer deductible. This includes food and drinks at such entertainment events. Although team building entertainment events, on the other hand, are 100% deductible. The tax code considers expenses for recreational, social, or similar activities for benefits of your employees as an operating expense. Next, we have business use of home. Business use of home is considered one of the IRS's dirty dozen, which means it's on the official government list of ways people potentially scam the IRS. In turn, that means you're more likely to get audited over this deduction, so pay attention if you plan to take this deduction. You can claim your home as a deduction whether you rent or own, but you must meet certain conditions. Number 1, exclusive and regular use. You have to use the section of your home for business purposes exclusively, and you have to use it more regularly than somewhere else. For example, you're working on your sofa while watching Netflix with your family on a Saturday doesn't count, but you have a separate bedroom where you work as a primary office, that would count. Second, principal place of business. The space doesn't have to be the only place you work, but it does have to be where you keep your records and where you do your overall administrative activities. There are 2 ways in which you can take a business use of home deduction: simplified or actual. Simplified method. The IRS allows you a rate of $5 per square foot up to 300 square feet of space. Second, actual method. This requires you to track all home expenses, which may include mortgage, interest, rents, insurance, utilities, and any other repairs and maintenance as a percentage use of home. The percentage rate is calculated by taking the exclusive business space square footage by the total square footage of your home. Direct business use of home expenses can be deducted at 100% of cost because it is directly related to the exclusive office space. Example would be painting your office. Which method you elect will depend on which one will give you the better tax benefit. You can use IRS Form 8829 to help you through this or hire a professional.